So let's talk about something that's being talked about lately about stock market valuation, Randy.
Okay. All right.
This chart gets trot out every so often.
Yeah.
The S&P 500 CAPE ratio versus its historical average.
Mm.
So Robert Shiller, who I believe is a Nobel Prize winning economist,
Hmm.
invented this CAPE ratio. The CAPE ratio is simply cyclically adjusted PE ratio. What is that? What you do is you take 10 years of earnings and you take 10 years because you're trying to adjust out the cyclicality in those earnings.
Okay.
You're averaging those 10-year earnings, and it's you take the current price over that 10-year average.
Okay.
So it results in a much higher PE ratio for the market because you're taking 10 years of earnings.
Yeah.
Hopefully, a company is making a lot more money today than it did 10 years ago.
Right. Right.
But you're averaging all that as though that was just yesterday.
Hmm.
Okay, so this chart now is getting some attention because we are approaching the all-time high here of 44 back in the dot-com boom.
Right.
And if that was a bubble, then this must be a bubble too,
Must be. Must be.
kind of thing, right? And you can see here the average is 18.
Okay. Okay.
So you've heard me kind of, get on my high horse and talk about the problems with PE ratios.
I
There's
have.
there's nothing forward-looking in any of these numbers.
Right.
It's all looking backwards.
Exactly.
Now, for most companies, if you're in a stodgy industry where you're only growing, 6, 7% maybe a year, then fine, doing this 10-year average might be fine, but it doesn't take into account companies like Nvidia, like
Sure.
Tesla, like Palantir, like a whole bunch of others that suddenly hit this hockey stick of growth, this exponentiality in their business models that takes off.
Hmm.
So this is interesting. Just be careful with this.
Yeah.
Um, a lot of people like to talk about this as though this is, physics. It's not. Um, yeah, it's just interesting. Just be careful with this. Again, you're averaging 10 years of earnings. It's not looking forward. It's like driving a car looking in the rearview mirror. In this case,
Exactly.
you're looking down the road where you were, 10 hours ago,
Right. 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 Yes.
right? You could be in a totally different state now,
Yeah.
right? And we are in a totally different state with respect to the stock market than we were 10 years ago,
Absolutely. Yep. Yep.
right?
Yep.
So just be careful with that.
Hmm.
A lot of people are sounding the alarm over this and saying, stocks are overvalued, get out of the market, et cetera, et cetera. Here's another one that's kind of interesting, and I'll just direct you to the bottom of this chart, and it's looking at companies by different market cap categories, right? So we've got mega caps,
Okay.
500 billion and above, there's 17 of them. This is in the S&P 500.
Okay.
Large, between 100 billion and 500 billion is 91 companies. Mid, between 25 and 100 billion is 227 companies in that category. And then small, less than 25 billion, 168 companies. Okay, and I'll stop moving my cursor around because we're going to lose visibility of the numbers. But on the right side, we've got the NTM, next 12-month PE. So at least with these numbers, we're looking at the price to earnings based on the expectations for the next
Right.
12 months.
Right.
Okay. So the current PE for those mega caps is 31.
Hmm.
Okay. The current PE for the large category there is 22.1. The PE for the mid is 19.8, and the PE for the small is 16.5. So you would look at this, and a natural conclusion might be, oh, the mega caps are super expensive and the small
Hmm.
caps are super cheap. What this doesn't show you is the growth of these companies,
Right.
right? Maybe 31 times next 12 months earnings is warranted because those companies, as we saw in the previous show that we did, they're accounting for 75% of the growth in the S&P 500 from an earnings perspective.
Yep.
That's where all the growth is coming from. Actually, the small cap companies may be expensive because they're not producing any growth.
Sure.
So don't just look at charts like this and tables like this and make any judgments without understanding what's actually driving these numbers. Okay. On
Yep.
the
Yep. Yep.
surface of it, they look cheap because you're in the 35th percentile. You're in the bottom, one third
Right.
roughly, right? So you might say, "Oh, I'm going to sell the S&P and I'm going to buy, the Russell 2000."
Right.
That may or may not be a good thing to do. Just don't just don't do it based on just looking at numbers like this.
Exactly.
Okay. All
Yeah.
right. Let's
Yeah.
get to more specifics.
Okay.
This is kind of fun. Goldman Sachs compared the valuation of the largest tech stocks today versus the tech bubble.
Okay.
So we got December 1999 on the
Hmm.
left, and we've got the current on the right. So back in 1999, we had Microsoft, which had a next 12-month PE of 69 times earnings.
Mm.
Okay. Cisco, 101. Intel, 32. Lucent, 49. IBM, 28. Time Warner, which was about to merge with AOL, I think in January, that
Yeah,
announcement was made,
that worked out. That worked
217.
out well.
Yeah, right. And Oracle and WorldCom. All right, fast forward to today. All of the top companies, Nvidia, Microsoft, Apple,
Wow.
Alphabet, Amazon, Meta, Broadcom,
Wow.
they're all under 40,
That's an amazing chart.
right? And again, this is just next 12-month PE,
Yeah.
which is flawed, deeply flawed, but at least
Yeah.
we're comparing apples to apples here in some
Yeah.
sense.
Yeah.
Okay. Now, the one that jumps out at you is Tesla, and you say, "Oh my gosh,
Yeah.
what an
Yeah.
overvalued company that must be."
Yeah.
Again, this is to my point that when you value a company, it's based on all future cash flows, not just next 12 months.
Right.
And Tesla has the potential to have this hockey stick of earnings growth over the next few years.
Hmm.
So a higher PE today is warranted because we're expecting much higher growth.
Right.
Okay. But
Well,
still,
we're only talking about two, may potentially the two largest products in the history of the human race. But other than that, what do they got?
just the car company, Randy.
The car company.
But the median today of those top companies is 31 versus back in 1999 it was 41.
It's really,
So,
really interesting.
again, this is not even apples to apples. What was happening with the internet is very different than what's happening with AI today.
Sure.
Okay. So, as
Yes.
interesting as this is, again, it's not apples to apples in terms of that. Okay. Stephen Mark Ryan. We don't usually talk about him on your show, but I thought this was pretty funny.
I'm a fan of Stephen.
Yep.
Yeah.
Okay. Someone just sent me a copy of their 10-year Tesla valuation model, which caused them to sell Tesla stock in the 200s earlier this year. So, according to Stephen, here's the model. Vehicles, the competition's coming. Energy, not cars, therefore ignore. Robotaxi, everyone will press the magic catch up to Tesla button. Optimus, does not fit in my spreadsheet, ignore. So, I thought that was pretty funny.
Yeah, that is funny.
And there's a certain person that he's directing this towards that I won't mention here, but um, so here's my words of advice to people. Wall Street is always focused on the next 12 to 18 months.
Mhm.
Right. And when Wall Street talks about PE ratios, it's usually, the next 12 months,
Mhm. Mhm.
which is what we've just been looking at the last few slides.
Right.
And they typically don't really think about where a company is going to be. Here we are in 2025, we're finishing up Q3. Most people now are looking into 2026,
Mhm.
right? So kind of 15 months out.
Right.
Most analysts are not really looking at 2027,
Mhm.
and they're definitely not looking at 28, 29, 30. If they do, it's just kind of a casual, you know, oh, I think the growth will be decent, but they don't really think about it that deeply.
Right.
And what I'm saying is, if you're a retail investor, you actually have an advantage over Wall Street because you can think 2 or 3 years out, or even longer if you want to,
Mhm.
right? And you've seen the modeling that I do. I look out typically 10 years,
Right.
right? But this is actually a huge advantage that you have over Wall Street, which does not, will not, cannot look beyond the next 12 to 18 months.
Yeah. And of course there are a very few exceptions that do look out longer, but it's really amazing to see those exceptions. And by the way, Cern, thank you for the setup because last weekend, just a week ago from now, I think it was last weekend, I did do my 2026 analysis, my 2027 analysis, and even my 2028 analysis, because if you want to understand the price valuation, if you even want to know the stock market estimate of the price valuation at the end of 2026, you got to be looking at what's going to take place in 2028.
That's right.
And so I just did those. And that's how I came to my year end this year, 700 to 1,000, year end next year, 1,500 to 2,000. So and it's all based on what is Tesla going to be doing 15, 18, 24 months from the point of the stock where the stock is trading at that time.
Yeah, it's interesting because everybody on Wall Street has been trained in the art of a discounted cash flow model,
Right.
but
They never.
no one uses it. And they don't use it because it's too complex. There's too many variables, too many unknowns. So it's easier just to do a shortcut PE method and say, well, the competition's trading at 30 times earnings, but this company's growing faster, so I'll give them a PE of 40. It's much easier, Randy.
So, CERN, let me ask you a question. The president of the United States has recommended, I mean, this guy he's, people totally underestimate him. Nobody else is talking about this, and all of a sudden, out of the blue, he says, we should eliminate the quarterly earnings reports and
Yeah.
go to every half year. We've only been doing quarterlies since 1990, I think. I think,
Yeah, I don't know when it started.
I think,
Certainly my whole career, that's been the standard.
I want to say it was 1990. It might have been before 1990, but it's not even been my entire career
Yeah.
that we've been doing quarterlies. And he says, this having to, and we know that one of the reasons that companies are no longer going public is because they don't want this, the public hanging over the company in such a cloying way. Maybe going to half year instead of quarterly would help that a little bit. What do you think? What do you think about the idea?
I understand on one level what he's maybe trying to solve is that, certainly the compliance costs of filing quarterly and doing audits and all this stuff is a hassle, putting together the financials, right? And then of course you've got investors that are focused on short term and the quarterly results. One quarter does not make a company. So I get all that. But on the other hand, actually, I would be encouraging just the opposite.
Hmm.
And maybe not officially, but companies should almost today be able to give us real-time information.
I see.
And I think that actually, to the extent that companies can do that, I think that investors will feel a lot of comfort around that.
Hmm.
Now, there's certain real-time information that companies maybe won't share and shouldn't share from a
Right. Right.
competition standpoint,
Hmm.
right? But I'm starting to see a little bit more of a trend in that regard in terms of companies sharing more and more information.
Yeah.
Elon does a nice job of sharing a lot on X,
He does.
right? Just to, not necessarily about business metrics and so on, but
Right.
he's
Right.
a very talkative CEO in that
Yeah.
regard, right?
Yeah.
A lot of CEOs don't say anything between their earnings calls.
Right. Right.
So, if we're trying to solve that investors are short-term focused, that's not the answer, Andy,
Hmm. Hmm.
right? Moving to every 6 months.
Hmm. Hmm.
If we're trying to reduce the compliance costs and all that, make it less burdensome, okay, fine. I'm all for that. That's great.